Everyone is chasing AI stocks right now, but the bigger investment opportunity isn't in the obvious names. Very few investors are asking what actually powers AI. Because behind every AI model, there's electricity, cooling, and data infrastructure that's working non-stop. And that's where a completely different set of companies sit, creating a new opportunity no one is even looking at. So we did the hard work. We spent time mapping this entire ecosystem, how it actually works, where demand is building, and which businesses are quietly benefiting. And from that, we've picked 5 companies where this opportunity is already visible. Hi, I'm Aparna, and in today's video, we'll break these 5 stocks down, their business, numbers, and risks so you can clearly see where the real opportunity might be. Let's get right into it. Let's start with stock number 1, MTAR Technologies. It basically is a precision engineering company. They build extremely complex components for industries where getting something wrong isn't an option. Think clean energy, nuclear, and space. Now, the AI connection here is not obvious at first, so let me walk you through it. MTAR's biggest client is Bloom Energy. Around 60 to 65% of their revenue comes from them. And MTAR supplies a large part of the key component used in Bloom's fuel cell systems. Basically, the core part that makes these systems work. Now, here's where the AI connection comes in. Bloom's fuel cells are being used to power AI data centers. Because data centers need constant, reliable power 24/7, and fuel cells are designed for exactly that. And this demand is scaling fast. Brookfield has already committed a $5 billion investment to expand this space. So the chain looks like this. More AI data centers need more fuel cells means more orders for Bloom, which means more revenue for MTAR. And the numbers back this up. Every 1 gigawatt order that flows through Bloom can create up to 1100 crore of revenue potential for MTAR. To put that in context, their current annual revenue is 676 crore. So we are talking about order sizes that could be larger than the entire company's yearly revenue. Bloom Energy has already signed a 2.8 gigawatt power deal with Oracle specifically for AI data centers. That's a massive pipeline of demand flowing toward MTAR indirectly. And MTAR is also moving from being an indirect beneficiary to a direct one. They have already won a 35.56 crore data center order of their own to be executed by December 2026. And the market has started noticing. This is how the stock has performed over the last 1 year, around 245% returns. But yes, there are risks too. About 60 to 65% of revenue is coming from one client, which is a real concentration. Bloom's own execution matters as much as MTAR's. And those data center orders need to be delivered on time. These are the 3 things to track closely over the next 2 to 4 quarters. Now let's move on to stock number 2, which is Aeroflex Industries. Now most people think about AI and imagine chips, software, or servers. Very few people think about heat. But here's the reality. As you pack more and more computing power into smaller and smaller spaces, the amount of heat generated becomes a serious problem. And managing that heat is not optional. If you don't solve it, the hardware breaks down. So cooling is actually a critical part of AI infrastructure, and it's only becoming more critical as compute density keeps increasing. That's where Aeroflex Industries comes in. Aeroflex builds precision flow solutions, basically the systems that control the movement of liquids and gases. And now they are entering the liquid cooling segment for high-density data centers, which is exactly the kind of cooling that AI infrastructure needs. Last quarter, the company delivered its highest ever revenue at 121 crore with EBITDA margins of around 23.5%. And that margin improvement is coming because liquid cooling and precision assemblies carry better margins than standard hose products. So as the product mix shifts, the financials improve alongside it. The real trigger here is the scale up they are executing right now. They've already completed their first commercial dispatch of flow control components for data center cooling. And they are scaling annual production capacity from 2,000 units to 15,000 units by June 2026. That kind of capacity ramp only makes sense if you have strong demand visibility. There's also a long-term supply agreement with a US-based company which gives them a steady order pipeline in a segment that's expected to grow from roughly $3 billion to over $20 billion globally. They also made a smart capital allocation decision. They basically pulled back capex from lower priority segments and redirected it entirely towards liquid cooling and automation. That improves return ratios and reduces the risk of spreading too thin. Now, exports also grew 30% year on year with over 70% of revenue coming from international markets. Now, let's look at the stock performance over the last 1 year, which is 67% returns. But yes, there are risks. This is still early stage. The opportunity is large, but scaling liquid cooling successfully, managing export volatility, and delivering the capacity expansion on time, those are the execution milestones that will determine how the story plays out. Now, let's move on to stock number 3, which is Bharti Airtel. And before you go, but Airtel is just a telecom company, hear me out. Because something very different is happening inside this business. But first, think about how AI actually works in the real world. A company runs an AI workload. That workload sits in a data center. Now, the data center then connects to cloud systems. Those cloud systems connect to enterprises and users. And every single one of those connections runs on infrastructure companies like Airtel provide. So Airtel isn't just in the background here, it's sitting right at the layer that connects users, enterprises, clouds, and data centers. Every AI workload directly or indirectly touches what Airtel is building. Now look at what the business actually looks like today. Last quarter revenue came in at 53,982 crore, growing at 19.6% year on year. EBITDA margins are at 57.7%. That's a company scaling fast while keeping tight control on costs. Now, what's growing within that revenue is interesting to see. Digital services are growing at around 39%. Enterprise segments like cloud, cybersecurity, IoT are seeing strong traction. The business is gradually moving away from plain old connectivity and toward higher value services. And then there is Nxtra, which is Airtel's data center business. They are planning to scale all the way up to nearly 1 gigawatt of capacity. That's a direct bet on how much AI infrastructure is going to be needed. And you know, the detail that I found really interesting while I researched was that almost 70% of their own customer interactions are now handled by AI internally, and their network optimization is increasingly automated. So they are not just selling AI infrastructure to others, they are also using it. They are also building AI-ready cloud infrastructure in partnership with IBM, which moves them beyond just connectivity and into actual enterprise AI deployments. Now, this is how the stock performance looks like over the last 1 year. It gave minus 2% returns. Now, let's look how the story plays out. And yes, there are risks you need to keep in mind. Growth still depends on ARPU expansion, enterprise deal execution, and how effectively they scale data center investments, and regulatory environment and pricing pressure can also affect cash flows in the near term. Now with that, let's move on to stock number 4, which is Netweb Technologies. Now here's a simple but important point. You can have the best AI model in the world, but if you don't have the compute infrastructure to actually run it and train it, it doesn't matter. That's the space Netweb Technologies lives in. They design high-performance computing systems, GPU-based servers, and supercomputers which are used for training large AI models and running data-intensive workloads. They're not a software company, they are not a chip company, they build the actual machines that AI runs on. And the numbers from last quarter tell a very clear story. Revenue came in at 805 crore, growing 141% year on year. Profits at 73 crore were up 147%. Both are improving because as the business scales, operating leverage kicks in and more of each rupee of revenue flows down to profit. But the number that really stood out to me is that 64% of Netweb's revenue in the last quarter came specifically from AI systems. That tells you that this is not just a company benefiting from a broad tech trend, it's a company whose core business is AI infrastructure. Their clients are a mix of enterprise and government projects, both of which are ramping up AI deployments significantly right now. Now, one thing to understand about their business model is that it's driven by large orders, where a single deal can move quarterly numbers significantly. So growth is strong, but it can look uneven quarter to quarter. Managements and analysts are expecting a 30 to 40% growth trajectory over the next few years. And the stock has reflected this momentum. It was up nearly 151% over the past year. Though it's traded in a wide range of 1,397 to 4,480 rupees, which tells you it's a high growth but high volatility name. And the risks here to watch are large order execution, how enterprise capex cycles play out, and whether current valuations are giving enough room for error if a big order gets delayed. Okay, for the last part, I'm actually covering two companies together because they sit in the same layer of the AI ecosystem and it makes more sense to understand them side by side. So we're going to talk about Sterlite Technologies and Finolex cables. Think about this. AI systems generate and process enormous amounts of data. That data has to physically move from one server to another, from a data center to a user across cities and countries. And the physical medium that carries all of that data is optical fiber and cables. So as AI adoption increases, data movement increases, and as data movement increases, the demand for high-speed fiber and cables increases. That's the thread connecting both of these companies to the AI story. Sterlite Technologies has evolved from being just a telecom cable manufacturer into a full end-to-end connectivity solutions provider. Their focus today is on high-speed fiber networks, low-latency connectivity, and data center infrastructure. The business mix is shifting in an interesting direction. Enterprise and data center segments are currently contributing about 20% of revenue, and management expects that to move towards 30% over the next 12 to 18 months. Last quarter, they secured over 500 crore of data center related orders specifically. Revenue grew 26% year on year to 1,257 crore, and they hold 780 plus patents with a presence across 100 plus countries, which gives them a genuinely global position in this connectivity cycle. Now, the second company, that's Finolex Cables, is playing in the same connectivity layer but with a more focused approach. Cables and wires rather than end-to-end infrastructure. Their exposure is through optical fiber and communication cables that handle rising data loads as AI systems expand. The numbers here are solid too. FY25 revenue was around 5,318 crore. Last quarter revenue grew 33.7% year on year to 1,640 crore, driven by telecom expansion, housing demand, and data center build-out. Brokerage estimates point toward 12 to 13% CAGR over the next 3 years. Not a rocket ship, but a reliable, steady compounder. Now, the honest difference between the two is this. Sterlite is more directly tied to data center and AI infrastructure growth, which means higher upside but also more exposure to execution risk and margin pressure. Finolex is a more stable play. It benefits from the same trend but in a more steady, less volatile way. Now, the risks for both include copper and fiber input cost movements, dependence on global telecom capex cycles, and how consistently infrastructure demand plays out over the next few quarters. So let's just step back for a second and look at the companies that we've covered today. These are not just companies chasing the AI trend, these are the companies without which AI at any real scale cannot simply function. And most investors haven't fully connected those dots yet. Also, if you haven't watched our earlier video where we have mapped out the full 25 company AI and data center ecosystem, that's linked right here. It's definitely worth watching. Now, I want to hear from you. Do you hold any of these companies and which one surprised you the most? Drop it all in the comments. And if this video helped you connect a few dots today, that's exactly why we make these videos. So hit like, subscribe, and we'll see you in the next one.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.